Happy Monday, everybody. Welcome to our Straddles and Strangles webcast. I'm Connie Hill, Senior Manager and Education Coach here at Schwab. You know, sometimes it's hard to determine when should I do a straddle, when should I do a strangle, when might it be appropriate. And so we're going to discuss all of those variables here today so that you have a good feel for when do you introduce this strategy? What is it appropriate to use for? All right, so those of you that are new, hopefully that will help you out as far as understanding where these strategies fit in. Hope you're following us on X. I'm Connie Hill, CS. We have the pleasure of having Rachel in our chat today. Rachel, her X is Rachel Dash, just DASH CS. So we post educational content throughout the day, things that we notice in the market that we think you might find interesting because we found it interesting. We'll share those with you. So we'd love to have you follow along. Let's go through our disclosures and get on with our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes only. Don't consider it a recommendation. We'll be using the Paper Money software application. That's what you download to your computer. It's the most robust version of Thinkorswim. We'll be using the Paper Money platform on that, which has some variances from a live account. One thing, it does not assign short option positions early, although a live market can do that. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. All right, we're going to take a quick look at the markets like we typically do. It does not really matter so much as far as what we do as strategies, but it's always good. I should say these two strategies. However, it's good to know, well, what is the market looking like today? What should we expect from it? We'll be discussing how do you set up a straddle or a strangle. We're going to look at some examples. We're going to look at our examples from last week, see how they fared, and of course, put on some new ones here today. All right, let's head over to my Thinkorswim. And looks like we're up a little bit, ever so slightly, 0.11% on the SPX this morning. You know, it's held this huge gap up. It's held it pretty good, which I think is encouraging to traders, right? Sometimes the bottom of that gap will act as support. So yeah, it looks like things haven't gone below there. What does the NASDAQ look like? It was in similar shape with the SPX today. Let's see. It looks like it's eking out a gain right now, 0.15%, which is helpful, right? And if the NDX is up, the SPX is up, what should the VIX be doing? What would your expectation be? Well, hopefully you'd think, well, the VIX isn't up as well, because typically it trades the inverse, right, of those indexes. So we can see that it's dropped a little bit. It's still in somewhat high territory. It's just a little bit below 20 here. And so it's still, I'm going to say, at elevated levels. Where it might not be quite as elevated, let's go out to, say, a one-year chart, is when it gets down here in this lower range. Looks like the low this year has been around 13 and change. So it gets down here, you know, below 15 or so, 16, then you're feeling a little bit more comfortable, like the market's a little bit less volatile. So I'm going to say there still is some volatility in the market. However, maybe not quite as extreme as what we were seeing 2 and 3 weeks ago. All right. Let's do this. Let's take a look at our trades that we had last week. And let me come over here for a moment. I have one trade still on, and you guys don't even know about this trade. Let me kind of clean this up a little. It's UAL. Okay, why do I have UAL in here? I have UAL in here because I was doing an experiment. And the experiment that I was doing is knowing that they do not have their earnings until, let's go look at their chart on UAL. Link that back up. Their earnings is, I believe it's next week. So the 21st, which would be next Tuesday, okay? And what I wanted to do is see if we could see implied volatility ramping up and if our options would then spread. Well, with this giant move here, that was on Wednesday. It really actually made a pretty big move when oil prices went up and shot up again. So a huge move in it. So my experiment that we were going to see here, I think, is not working so well. Let's just take a look. Let me spread this out a little so we can see which one's the call, which one's the put. So the top one is the call. So we paid $6.40 for it, and it has gone down a little bit in value. And the put has actually gone down in value as well. Now, many times as we're going into an earnings, the implied volatility ramps up. We're not really seeing that take place in these options. Let's add to our studies a couple of things. One is the market maker move. And I decided to show you how to put it on, so those of you that aren't familiar with this process would be able to see. Now, MMM is what we call the market maker move, and it will plot what is priced into the options, the at-the-money options for the event being earnings, which isn't until next week. So I'm going to share that formula with you. Let's get that over. So let me double click on it. That's not the one I wanted. I wanted the bottom one. And I'm going to share that script with you as well. The other thing we want to put on here that we'll look at a lot is implied volatility, especially with this particular trade. IMPV. There we go. And let's make this one, we'll just make it like, say, a 3. All right. So I was telling you that the implied volatility, instead of ramping up because of this big move, I think tied back to what's going on with oil, interestingly enough, it dropped the implied volatility. And so that's why both of the positions are not doing as well. Okay, let me share the MMM with you out in the chat. Those of you that are here live can just take that script. And remember, the scripts are not guaranteed as to accuracy or timing. But what you can do is you can just, grab the formula, and you can either start right at that exclamation point and grab it starting there for those 9 digits. I'm going to put this in a text message. So those of you that are listening to this on the recording, I guess it doesn't want to do that. You'll be able to see that. Basically, you copy that script over or type it in if you're looking at it from the recorded version here. You can type in just from the exclamation point on, or you can copy that whole URL. It doesn't matter. Hit preview, and then you're going to want to import. I'm not going to hit import because I don't want it in there again. I only would like it in there once. Okay, so that's what you do to get that in. Now, those of you that are on the recording, let's get this in a little text box. Come on, little text box. There we go. I know many of you have said, hey, that's really helpful when you post that out there, out in the chart. So just go ahead, pause it, write this down. It is cap sensitive. You've got to be exact on every single character there. Okay. Very well. Somebody's letting us know that Oracle is strong today. It very well could be. We won't necessarily go and try to hunt those particular ones down. Let's take a look at how our other trades fared. Okay. I think this is really an important aspect of this class is how do we manage the trades? Because it's easy to just throw them on while we're in our class, but the real trick of it is managing it once the earnings come out. Now, this market maker move, for those of you that maybe aren't as familiar with it, it's essentially what is the option, the at-the-money options pricing at for the event, which what we're going to use is earnings. Sometimes it might be something other than earnings, but in our case, earnings works out quite well. Let's do this. Let's take a look at one of our trades from last week, and maybe let's go to maybe a 3-month chart so we can see this pretty well. Delta Airlines announced the morning of, let's see what that day was, the 8th of April. So that was last Wednesday morning before the market opened. And so we got in the trade here on Monday. Okay. It had a huge gap. I mean, it went here all the way up to here the next day. So it was really a pretty big gap. And initially it looked like it was going to run up, and it did, but then it just started to fade. And then it faded down past where it actually gapped up to. So we found ourselves in a situation of making some decisions pretty quickly. All right. Let me show you how those actually fared. If we come over to the monitor and the account statement, let me just show you the values. So we, in this case, did a straddle. So we bought the at the money call and put, which was the 67 strike price. And for that trade, they cost pretty close to the same amount, which is nice if it works out that way. So the initial net debit was $593. So we know we need the stock to try to make that kind of a move to make up for the two premiums that we have there, right? One of them we're going to consider is kind of a throwaway, that the stock doesn't go that way if it makes a decisive move. In this case, it popped up. So it was like, okay, we're going to run with the call. Let's sell what we can of the and see what we can get out of the put. Okay. The time on that was at 7:34. Now the market opens in my time zone at 7:30. So that's about 4 minutes after the market opened. And it looked like we could see what was going on. We're able to get a little bit out of it, a decent amount actually, 72 cents. And so to figure out, well, what is my break even now? Take the difference between 593 and the 72 cents. And then you have, hey, now I need the call. I want the call to go up as high as X to now break even. So in this case, the 593 minus the 72 gave us a value of 521. Okay, so then my brain's thinking, okay, we need to get at least 521 out of the call. You're going to see here, we exited just only about a few minutes later, like 6 or 7 minutes later than we did on the initial one. So let's go look at the chart. Let's go to the 5 days, 5 minutes. Let's get the right one here. Let's go 5 days, 5 minutes. And then I'm actually going to do this. I'm going to change the time frame to 5 days, 1 minute. And then we're going to zoom in on where we see this happening. So we got out, I just marked that kind of generically, so we're on that day. But let's just maybe remove that. And let's kind of look at the timeline, okay? So Delta announces, takes a while for the market to react, pre-market, but eventually it really kicks in. It's ramping up, that it has this big move up. And it's nice to be able to see that in pre-market. And so I'll pull it up, and I'll encourage you to do that as well. Why didn't MMM appear after adding it to the chart? Sometimes it takes a minute to calculate on that. When I put it on, I think the SPX was up, and so the SPX doesn't have a market maker move on it, okay? But you can see on this one on Delta, it now has the market maker move, but it's really small right now. The big event is basically over, and that'll probably drop off pretty soon, okay? So when the market opened up, and I'm just going to kind of zoom in here, what we saw was we basically saw a big gap up, candle ran, candle went a little bit sideways, and then here's this big volatile candle. Look at this, look, it goes down to a low of 72.25, and it goes up to a high of 74.19 in 1 minute, okay? That was at 7:32. When we started to see that kind of volatility, here's the 7:34 candle. I think that's the candle we decided we got out pretty quickly at the let's see, let me go back there, 7:34. Okay, so when it started to do that, let's go back to our chart here. This would be 7:34. Then we were starting to lose some profits here. So that's why we got out so quickly. On that put, we're saying, okay, the put's not going to work. Let's get out. And then it's at 7:41 is right here. We were starting to lose what we had gained with that call option. And so then the decision was made, well, let's just get out. Let's make something out of the trade. It's not as big as what we hoped would make out of the trade, but let's get something out of the trade. So we ended up not having a huge gain on it. It was like $19. Okay, but better than a loss, better than a poke in the eye. And if we come back here to say our 3 months, we can see kind of after that, it just kind of dinked around. It didn't really do a whole lot. So at this point, we would be really glad we're out of the call. We're glad we got out of the put, because the put wasn't going to get us anywhere either. Still isn't back to where it was prior to the earnings announcement. Now, this market maker move, we'll talk about it a little bit more in depth when we put on some new trades here, okay? Let's see. Yeah, you saw it. Okay, yeah. Once I pulled up another stock that really had a market maker move, then it turned out. All right, Levi was our other trade. Levi Strauss. So same thing, we got in early on Monday, and then they announced, when did they announce? They announced the 7th, which was Tuesday after the market closed. So both Delta and Levi really had the first reaction to the, with the full market engaged Wednesday morning. So that's kind of going back and forth between the two. I try not to do that too much, not stack too many on a morning, because it makes it a little bit difficult when you really want to be tracking it. You can see the huge implied volatility crush here. So when we talk about the implied volatility coming out, you can see, man, it just really dropped. And that's normal, right? Because the news is out. And so the implied volatility piece of that premium that we traded, man, it comes collapsing out of the call, out of the put, all across the entire option chain. Okay. It impacts the ones that have a lot more implied volatility baked into them, like the ones, like the weeklies, typically of the week that it is due to expire and announce. So here, in this case, it had a pretty decent pop up. And again, we got out of this on the same day, but within a few minutes. So let me just show you. We'll change this over to Levi. So on Levi, we did a straddle here as well. Now this one is a little bit lower priced of a stock, so those with maybe smaller accounts might find it a little easier to participate in it. Versus sometimes, we have a straddle that costs us $10, which is $1,000. So this is a little bit smaller, which I think somebody with a smaller account, or just trying to maybe use a small part of their account for something speculative like these trades are, then you have it. All right, so 120.70 cents gave us a net debit of 190. Okay, let's see when we closed out. We actually closed out of these two together. And what I was seeing that the call side was the one that was going to react favorably, but I was concerned. Let's go see what it looked like. Oh, actually, we didn't do them together. I take that back. They are together, but exactly an hour off. I was seeing that. So the first one was 7:34. The second one was at 8:34. Okay, so what did we do? We said, okay, the put's not going to profit us. Let's get something out of it. So we got 25 cents out of it. And so again, then I'd come in here and I'd do my break even. In this case, it was 165. Okay, let's go look at the chart at 8:34. All right, so we're going to come back here to our 1 day. Well, I want a 5 day, 5 minute, and then okay, then let's see here. 5 day, 5 minute, and 15 minute, and then let me change this to 5 days of 1 minute. I should add that. All right, now let's come back here. Let's track it. Okay, so pre-market starting to run up there. And let me just remove that for the moment. Let's zoom in. So the first time we got out, look what happened initially once the market opened. Gapped quite a bit, ran, and then it started to fizzle. Look how quickly that kind of fizzled. It still held a gap up. It was still pretty nice. 7:34 is right on this candle. And that's when we initially got out of the put, because it looked like, okay, the call is going to keep the momentum. Yeah, it pulled back some, but it was a really pretty decent sized gap, as we saw. Okay, and then we said, okay, we're going to run with the call. Let's see if it can make up some distance here. Because at that point, after selling the put and getting back a little bit on it, then our new break even was about 165. So 190 minus the 25 cents gave us a new break even look at of 165. So then with a call, we're like, okay, we want it to go well beyond 165. And it did for a while. Let's see when 834 was. Okay, that's 817. This is 825, so maybe a little bit more. 833, 834 is this candle here. So when it got to a point that it was really starting to give back a lot of those gains, we're just seeing that shadow at the top, and the body getting a little bit bigger, as it was starting to pull back. So then we decided to get out of that one as well. Okay. We made not a ton of money on that either. We only made 35 cents per contract, but we had 2 contracts there. So then we were able to eke out a gain of $70. Okay. So really decent size moves. Now, why did we decide to do straddles on Levi and Delta Airlines? Well, the reason we did is because of a couple of things. One, it was anticipated that they would have a big move with their earnings announcement. Okay. And we went back historically and looked to see, well, in the past, have they made big moves? And the answer was yes. And we'll look at some other stocks here today, but you can go back and pull up, say, a 1-year chart and see just real quickly here to glance, gee, at this earnings, it had a big gap up. This earnings, whoa, it had a big gap down, and then it continued to drop. This one had a nice long candle, so it didn't, it did gap here, but then it ran up. So we're looking for gaps, we're looking for tall candles. And that gives us an idea if there's big movement. And then we see what the market has priced in the at the money options to tell us if we think it's likely to make a big move or not. And on Levi, initially when I pulled it up in the morning, there was this number here, the market maker move was 9.39%, which means, yeah, that's a pretty good size move. Levi, oh, I take that back. That was Levi. Levi was 9.39. Delta Airlines was 5.32. So Delta was not as much implied volatility priced into those options, which sometimes is a little refreshing because then you think, hey, if there's not a ton priced in, but it makes a bigger move, then you have an expectation, hey, maybe a straddle by an at the money call and put, or a long strangle, which is an out of the money call and out of the money put. So your net debit is less, but your break even, it spreads it out a little bit further, right? Because you're not doing out the money, you're picking something out of the money. So you're trying to weigh that. Now, if a stock was not expected to move that big over earnings, then we might not even consider a straddle or a strangle. We could, if we wanted, we could also consider selling a short straddle. So where we're selling both the call and the put. We could also consider a short strangle. We usually don't do those in this class because you get more money out of the straddle. You're going to sell at the money. Okay, then you're trying to get the most you can. So typically we'll sell that at the money straddle. And again, if we have a lot of implied volatility and we want to be a collector of it, then that's when we go for the short contracts. So I hope that makes sense to you. Those of you that are, I think a lot of you in this class are still trying to get comfortable with these strategies. And I'll tell you, they are strategies for speculative times, meaning they might not be your bread and butter strategy, right? You might have other strategies you like to use, other option strategies that are not as speculative in nature, okay? But there may be times when you do want to speculate or you want to hedge, okay? Say you have a stock you're holding and maybe they're being sued. And the date, they've announced, hey, on X date, we're going to let you know which way the lawsuit went, if it's dismissed or if it, you know, exactly what the outcome was. So somebody in that scenario might say, well, I don't know which way the lawsuit's going to go. I've kind of been happy with my stock. Maybe I will buy a straddle or a strangle just to have kind of a buffer zone there in case the stock makes a really big move one way or the other based on that news. Okay, so there's some different ways that you can use them, even though maybe they're not something you're going to do every day. Okay, because this is what our class is about, we do them every class. All right, let's look at a couple of new opportunities. Let's take a look at our first one, which is Netflix. Netflix has been historically a big mover. Let's look at a full year here. I would like you to see, oh, it is on a full year. Let's just zoom out. Oh, maybe that is 8 May's down there. Okay, we're good there. Netflix for many years has been a big mover. Now its market maker move we can see right now is about 6%, which is kind of like, I'm going to say, kind of a midpoint area of implied volatility. The one we saw, like I showed you on Levi, that was like 9% plus, that's pretty big. Sometimes we've seen some like 10 and 11%. Those are really pretty big. So 6% is just kind of in the middle of the pack, meaning some expectation of movement, but maybe not wild expectation. Okay. So you go back and we look at its history, and here it had a decent sized candle here. I wouldn't say it was a blockbuster move, but it moved. Okay, let's look in on this earnings. Okay, on this earnings, they usually do it after the market closes. So the next day would have been the reaction to the earnings. So it closed up here at 127, it gapped down here to 124, and then it dropped the rest of the day down to, what was that? Maybe about the closing around 120 and some change. So from 128 down to 120 is a pretty decent sized move in a day. Okay, so that one moved quite well. Let's go to the next one. Whoa, this one had a huge gap down there. So we're like, yeah, definitely was volatile. And let's see. Maybe here's our most recent one. It was not as big of a gap down. 89, it looks like. And then it gapped down here to 82. So that's a $7 drop, which is a little bit less than 10%, so maybe 9-something%. But then it continued to run up. Sometimes when they do not continue to go the direction that they fell, it can throw you off, because you're like, okay, with this big drop, you're thinking we're going to keep the put. The put's the one that's going to make us the money. And then you see it start to run up, and maybe when it was down here, you're like, oh, the call's not going to give us anything. Let's go see what we can salvage out of it. You sell the call, and then it starts going the opposite direction, and you're thinking, oh, maybe I should have held on to the call. Maybe I should have waited. There's a lot of second guessing that you can do. So one thing that traders will do is if they see a move that's pretty definitive and they see it as giving them a gain in the trade that they're, I'm going to say, satisfied with, maybe not happy because it's pie in the sky amount, but when you see something that you might be happy with, consider getting out of the trade, okay, as opposed to holding on forever. Does that make sense? I hope so. All right, let's look at what Netflix options look like. And actually, I'm going to go over here and see, does it have the ramp up of implied volatility? Well, it was ramping up here in the month of March. Really through the month of April, it really hasn't done a lot. It's actually come down, but when the price goes up, we expect volatility to drop. So it looks like maybe the last couple of days it's starting to inch up a little bit. So we'd see, okay, implied volatility is expanding a little bit here. And it could expand a little bit more until they have their earnings, which is on the 16th, which is Thursday after the market closes. So we'll be able to track this Thursday night, Friday morning, okay, is when we're going to see. Now, it could be that if we get a run up in the implied volatility, say on both a call and a put, if we've gone long, we might consider getting out before they actually announce. We haven't had any that kind of match that description yet. So, but you never know. We could, if we could have that as an exit rule if we wanted. If we had a good enough gain, say it's up 30%, you're like, hey, 30% is good. Maybe I don't even want to play it through earnings. Some people can do that. So from the trade tab, the other thing we're looking at here is the implied volatility priced into the options. And so you can see on these April 13 options, which expire today, it's about 60%. Now, the one for when they expire, what did I say, the 21st? So actually, it's going to be these with, no, it's going to be announced on the 16th. So it would be the ones on the 17th, okay, where options expiration is. And right now that's sitting at about 51%. Okay, this is when the earnings announcement would actually take place later in the week. So some people might be loaded into this one, meaning lots of open interest, lots of activity. And we're seeing, yeah, there's quite a bit of open interest there. And we could do that if we wanted. When you're doing these really short time frames, sometimes it might be a little bit easier on us if we were selling those options instead of buying the options, okay, becoming a seller at that point. So what we're going to do on this one, we're going to go out to May 1st. Okay, here's May 1st. That's about 18 days out. We're still going to see some pretty decent open interest here. And we can even see on my volume column here some activity going on right now today. Now on this, what we're going to do is we're just going to do a straddle. So that's the wrong stock. How did the not right stock get in there? Let's bring up Netflix. Okay, there we go. Fortunately, the other stock had some weeklies as well. Okay, so here's our Netflix. It's May 1 that we're actually looking at. I was thinking Netflix because we were looking at the, what was that stock we were looking at? Was it Avgo that stayed in there? I think it was Broadcom that was sitting there. It does have options that expire 3 times a week. Now that we're on the right stock, Netflix, it only has the weekly expirations on Friday. Okay, so we're feeling good. We're going to come down here. I want you to notice how much implied volatility is really priced here. 76% on these options that expire Friday, compared to 56% here. So it has 23% more implied volatility priced into the options that expire Friday. Could somebody, if they wanted to, sell that? Absolutely, they could sell that, right? We weren't planning to do that in our class today. But let's see if we were. 103 looks like the at the money strike price. And so if we were selling, we'd have about 340 there and about 340 here. Okay, see how they're pretty much right at the money and priced really, really close to each other, which wouldn't be a bad credit to bring in, right? Almost $7. That might be kind of nice. But what we are going to do is we're going to go out a little bit further in time so we have more time for the trade to work if we need it, if we want to have more time with it. Okay. And on this, we are going to do the 103s. So we're going to buy the 103 put and the 103 call. So I'm going to hold down my control key and click on the ask price on the call and click on the ask price or the put. Now we're doing the ask price on the call. So this one is going to cost us about $8.70. Okay. What does that mean? We need to plan on the stock moving up more than $8.70, even just to even break even on the trade. Okay. The market maker move right now is about $6 and let's call it 25 cents. Okay. 6.25, which isn't quite this whole amount, but we have more time on here. Okay. We have more time, a couple more weeks, so we can allow it to play out. And hopefully we can salvage one of the legs a little bit, like we have been on these previous trades that I showed you from last week. Or maybe one of them takes a really big move. Maybe we don't salvage much out of the leg that's remaining, but maybe we get some good distance out of the leg that we end up holding on to. Maybe it makes a big move for us so that it more than offsets what our net debit is down here. Okay, that's why they say these trades are speculative. Yeah, they definitely are. Let's go ahead. Let's cue this one up. We'll put it in our straddles and strangles. Come Thursday night, we're going to be watching it. We're going to watch their after hours, see what the initial reaction is. even though we might see what the initial reaction is, say Thursday night, it's not guaranteed to be there Friday morning. It could totally change by the next morning. And you'll notice sometimes as a conference call develops, sometimes more activity starts to take place because more information is received. And so just the initial reaction might not be the way that it really goes. Okay, so, and then on Friday morning, we're going to watch it, see if it opens anywhere close to that. Okay, we are going to be getting into the thick of earnings pretty quick here. And I think probably next week will give us some more volatile opportunities than what is going on this week. We're having some banks announced this week. The other stock we're going to do here, well, let me show you this. Some of the banking stocks did not have a big market maker move. So if there's not a big market maker move, there might not be good incentive to really trade the strategy, right? I mean, that looks like a decent sized move up there, but it's at 309 and go to 318 or drop to 299. It's kind of an expensive stock. Citibank is kind of similar in that there's not a lot of implied volatility priced in here. Okay. Therefore, we're not going to pursue any of those for a straddle or a strangle. If somebody wanted to, could they maybe sell a straddle there? Yeah, you certainly could if you wanted to take advantage of maybe what's priced in there. The stock we're going to go with is J&J, Johnson & Johnson, which has moved. Oh, that's even worse. That dropped. Ooh, okay, my strategy is going to change here then. Okay. Earlier, this one was up quite a bit. Make sure I'm on the right one. Yeah, this one's changed quite a bit since a little bit earlier today. Not sure why. Implied volatility is ramping up here a little bit. They announced their earnings on the 14th, which will be tomorrow before the market opens. Okay, so tomorrow morning is going to be busy for Johnson & Johnson. Because there's not a huge move expected here, I was going to do a strangle on this, and we still could. Let's go look at the trade tab here. Let's get the right stock in here on J&J. So it does have some weeklies here. So it has some good trading activity, which is really important. If there's not a lot of open interest in the contracts, we're really not that interested in dealing with them. It has about 11% more implied volatility priced into the options that will expire Friday. So there's extra implied volatility in those options, but I'm not going to say it's not extreme. Okay. With the $7 move on a $235 stock, those aren't really big moves. We can see here where the market maker move puts out, if it does go that amount, where it's expected to go to. So on this, let's change things up a little bit. And let's do this. Let's do a short straddle on the ones that expire this week. And then to give us a buffer, to give us a little bit of flexibility so that we are not putting max loss on a naked call exposed, then we're going to go ahead and put on some long options with it. Okay, so let me show you how this works. What we would do is sell the at the money, which is our 235. Okay, so I'm going to come down here. We're going to come on the bid price. I'm going to click on 235 and 235 on the bid price here. And that lets us bring in a credit of about 825. Now that 825 is bigger than the market maker move right here for the options that expire that week. That's a good thing, okay? And the bigger this is over the market maker move, the better. Okay, but this market maker move is for the earnings event, and implied volatility is actually priced out until Friday. So the move out here, come options expiration Friday afternoon, it's expecting the stock to have moved $8.51. Okay, which is different than just the event. Okay, got filled on our initial trade there. So we can put this in right now. But if we're exposed to a long call, we have theoretically unlimited risk potential, right? Say they come out with their earnings And in their earnings, maybe something spectacular happens, or they announce that they're being taken over by a company. I mean, Johnson & Johnson's pretty big, so that might not be that likely, but maybe something big happens. We'd be sitting here exposed with a naked call, and we'd be forced to go out into the marketplace to buy to cover it. And there are lots of accounts you can't have unlimited loss potential. And so we want to offset that. Okay, so for that reason, we're going to do what's called a straddle strangle swap, which means we're going to sell the straddle at the money. And then we're going to pick one of these others, maybe the next week out. Let's see. Here's the open interest. There's a little bit of open interest if we'll just do one contract here. And you get to decide how far out of the money you might want to go. Right? You might go out to a 30-something delta. In that case, we've got a couple of choices here. And we've got a 39 delta here. So let's do this. Let's buy the 240 call. And let's buy the 230 put. And that will help us so that we're not at a theoretical max loss of unlimited. Because that's kind of I'm going to say a risky position to put yourself in. And so some people have rules that they just would never even do that. And again, some of your accounts, you have to have naked call writing privileges, and it's not something that's commonly given out. Okay. But by doing that, we still have a decent net credit there of $1.90, and we would hope to capture quite a bit of that. Now, the risk that we run here is that it does make a really big move. Johnson & Johnson not predicted to make a huge move. And so, but the risk we run is that it does really make a big move, and it puts either our 240 call, or rather our 235 put or our 235 call at a big disadvantage. And we hurry to go buy it back, and then we have to make up the difference because it made such a big move. Okay, so that's basically what we're going to do on this one. So not what I exactly intended, but it's okay. It's going to give us experience with that strategy. Again, it's called a straddle strangle swap. Over here, you're going to see it as a double diagonal, because technically that's exactly what we're doing. We have options that are different strike prices in a different period than our long legs. And that is really the definition of a double diagonal. So we're going to hit confirm and send. We are going to send this to our straddles and strangles. We're going to send it on. Now, I want to make sure we answer your questions here, because they're probably, with this last strategy, a little bit more questions. So Coach wants to know, I want to understand, we could short the straddle with 0 DTE 17, but we're going to go long the straddle in May 1st. Yeah, we're doing both. So we're selling it short for this one that has lots of more implied. I mean, it's maybe not a ton compared to this month, right? It's 11% more, but the extra implied volatility, we're going to sell that. And then we bought the longer dated options to act as our hedges, our hedge legs. Okay. All right. That's going to be what we're going to be watching this week. So tomorrow morning, we're going to be all over J&J watching it in the pre-market, seeing what the initial reaction is. Now, I do hope all of you have subscribed to our Trader Talks channel. Makes it so easy to find our content. For example, here's our first class today. Trading a smaller account will be Barbara Armstrong coming up next in about 15 minutes. And let's see what Rachel teaches next. Rachel teaches this afternoon on ETFs. It's not recorded, so you've got to be there live in order to catch this information. She does a super job with that class. And so that might be something you want to check out here later this afternoon. All right, you guys, that's what we did. We followed up on our trades, really looked at the minutia detail and when we got out of them. And then we put on these 2 new trades that we're going to track this week. If you want to trade along with me, they're practice trades, they're example trades. You can do that in your paper money account. And really, that's the best way to learn strategies, is doing them in your paper account, but treating them like they're, that you're staying on top of them, not a throw it in and forget about it kind of trade. You really want to have a purpose when you're paper trading. So you're going to be tracking with it. You'll have questions that come up. And if you're tracking the trade that we're doing, you might have some questions that we can talk about when we're reviewing that trade the next week. Okay. All right, you guys, appreciate your attention here today. I did not see a survey out there, but if this was helpful to you, hit the like button on your way out. And I will also put that script, the Market Maker Move script, I'll put that in the show notes for those of you that are looking for that information there. All right. Thank you much, Lee Rachel, for helping out today. Thanks to each of you. We'll see you next week at the same time. Bye-bye.